Buying your first home in 2025 should be one of the most exciting events in your life. It's a huge milestone that you're likely, spent years working on and saving for. But a few hidden financial traps can turn that dream to a really costly nightmare. Today, we're going to break down the 5 biggest money mistakes that could stop you from getting into a home. Most importantly, I'll show you exactly how to steer clear of them and grab the keys to your new place with confidence. My name is Caesar. My credibility is I'm a real estate agent. I've been doing it for 3 years and about to go on to 4 years, working currently on getting my associate broker's license. I've helped many people to buy homes. I've helped over 20 plus people since I've started to buy homes. I've gotten them grants, assistance, and overall just educated them on the topic. So if you get any value from this, do me a quick favor, hit the subscribe button, and I hope you enjoy the channel. Going on to mistake number 1, probably the most common one, and it's getting fixated on the price of them. Buyers get laser focused on the down payment, but they completely forget about the tidal wave, the other costs that come right behind it. The reality is your monthly payment isn't just a mortgage. You need to think in terms of PITI, that's principal, interest, taxes, and insurance. Depending on where you live, property taxes and homeowners insurance can easily add to hundreds of dollars to your monthly bill, or sometimes in worst cases thousands. If you're looking at a condo or a home in a planned community, you'll probably have HOA fees, which can again be another $100 or a few, sometimes thousands, depending on where you're at. But the real budget killer that catches almost everyone off guard is closing costs. These are fees that you pay to actually finalize the loan and you don't get keys to the house. Lenders estimate closing costs run between 2 and 5% of the home's price. For a $400,000 home, you would need to have an extra $8,000 to $20,000 in cash ready to go. So what's the fix? You have to build an all-in budget. When you get pre-approved, don't just look at the loan amount. Ask your lender for a detailed estimate of your total monthly PITI. Then ask for a loan estimate form that will break down all your estimated closing costs. From there, you should have 2 separate savings goals. You should have one for the down payment and one for the closing costs. And you should have a move-in fund for immediate repairs or furniture that needs to be bought when you get the house. Otherwise, you're gonna end up on probably, if you're looking into homes, a lot of people will say this, it's house broke. By the way, I will talk about how to eliminate closing costs or how to lower them a lot later in this video. So if you're interested, just stay tuned for that, because it is possible. Mistake number 2 is that people fall in love with a house they just can't afford. The second mistake is usually what I just call house fever. It happens to a lot of us. And I mean, I used to scroll on Zillow and look at $10 million mansions, and I only had $10. So if you do it, it's not like the worst thing in the world. A lot of people want to have the dream kitchen, the yard, everything. You fall in love with a house, you see a house that has it, you're like, oh my gosh, it's so extravagant and whatnot. Problem is when you don't get, or you get pre-approved, and let's say you're only pre-approved for 200, and if a duplex you're pre-approved for 280. The houses you really want and the way they're at, what they have, their amenities and things like that, it's like 500,000. You just can't afford it. You shouldn't be sacrificing your well-being just to buy a house. It's just simple as that. But this is a huge mistake. Buying a home with just your emotional side of your brain, or we call it ethos, is probably one of the fastest ways to get house poor. When so much of your income goes to the house and you have nothing left for savings, travel, or small emergencies, as a rule of thumb, many financial advisors use the 28-36 rule. Your housing payment shouldn't be more than 28% of your gross monthly income. All your debt combined shouldn't top 36%. Pushing your budget to the max that a lender offers you often blows right past these guidelines, and it's just not safe investing or home buying. The solution here is pretty simple, but it takes a lot of discipline. Get pre-approved for a mortgage before you even start looking at homes. The pre-approval is a reality check, and the lenders look at your income, your debt, and tell you the absolute maximum you can borrow. You need to treat that number as a non-negotiable ceiling though. Don't even look at houses that are listed for more thinking that, oh, I could probably get it for less and things like that. Ultimately it's just too much variability, and that's just not good. Before we go to a third mistake though, which is one of the quietest and most damaging ones, I want to help you stay on track. I put together a free downloadable first-time home buyers financial checklist. It covers everything we're talking about today, and it'll help you stay on track in your savings and your documents in order. And the link is right down in the description. Go grab a copy. Like I said, it's free. Makes the process a whole lot smoother. And there should also be some links in the comment section below, or in the description, about different resources you can look at. So number 3 is ignoring your credit and ETI until it's too late. So this brings us to a really big issue. It's you're ready to apply for a loan, check your financial health, especially your credit score. Your debt to income ratio, or otherwise known as DTI, is just too high. A lot of people assume that their financials are in good shape. When they go on the application, things turn out differently. I'll give you a good example. I had a client before. He was wanting to get a pre-approved for a house that was $300,000. He thought he made good money. He thought his credit score was fine. He thought everything was pretty good. He applied to multiple lenders and they all pretty much told him 200, 220, 230. Was he upset? Just point blank period, he was. And that's just the reality of a lot of people. You just think, it's just we have cognitive bias. You just think that you're in a better position than what you're really at. A high credit score can save you thousands of dollars. A lower one can cost you thousands. So lenders are looking closely always at your DTI. So that's all your monthly debts divided by your gross monthly income. They want to see that you can handle mortgage on top of your existing, car loans, student loans, and credit cards. Most lenders want to see a DTI below 43%, and the best loan terms usually go to people under 36. FYI though, if you're at FHA, you can go up to, I think, 50. Last time I checked, someone can correct me on this, 55% DTI, but you don't want to go to high. Like what I'm saying is 36% is usually what you want to do. By the way, if I'm looking back and forth, because I have all these notes that I did, so I made sure that everything I was saying was legit and fact checked. So 36% is around the max DTI you want to have. If you have higher than that, I would say probably hold off buying a house until you can lower it down. Here's what you can do is check up at least 6 to 12 months before you plan to buy. Put your credit reports from 3 bureaus, Experian, TransUnion, and Equifax. You can do this for free once a year, or you can pay for it. Look for errors and dispute anything that you see that is wrong. Don't let dispute something just because you want to, fix it. It has to generally be wrong. If your score is low, work on it. Pay every single bill on time, obviously assuming that you can do that, and paying down your credit card balances. Then calculate your DTI. If it's over 36% mark, focus on paying down debt. Taking care of this in a year will give you plenty of time to build a financial profile before you apply. Now, a little FYI though, if you have a financial file that's just horrendous, like you have 40, 50, 60 derogatory marks or late payments, and you have all this other stuff, lenders can work with you, and they might charge you more interest rates though. But to combat that, make sure always have a letter explanation as to what happened, what was going on in your life and things like that. Focus on multifamily if you're able to, because you can help subsidize a lot of those costs that come with buying a house. Mistake number 4, and honestly, the next mistake is pretty common. And a buyer does everything right. They save, get pre-approved, they find a great house, and the loan is moving along. Then the final weeks of closing, they blow up the deal without even knowing it. The period between your application and closing is what we call the quiet period. Right before they fund the loan, the lender is going to pull your credit again, re-verify your job, to do a verification of employment, and check your bank accounts. Any major financial change can throw up a huge red flag and get you denied last second. And I've had it happen to some of my clients a good number of times now. So what kind of changes? Things like quitting your job you don't want to do. You don't want to quit your job. Financing a new car, buying thousands of dollars in furniture on a new credit card, making a large random cash deposit into your bank account. But you would think, why would I do that? It shouldn't help it. Some people's logic would say, yes, that would help it. But the way lenders look at it is they have to be able to trace that income, where it came from. And if they can't do it and they can't verify, they can't use it. And it has to usually be in an account for 2 months. So the simple solution is, put your financial life on hold as soon as you're under contract. It takes about 30 days if you're using FHA. Conventional, you can do in 3 weeks. Don't make any major purchases. Don't apply for a new credit card. Don't move big chunks of money around without talking to your LO or real estate agent. Don't change jobs. It's just what it is. All the other stuff you're looking for, it can wait until after. Oh my gosh, there's one client I had. Dude wanted things to move. He'd be like, bro, can I do it now? Can I do it now? Buy a new car and stuff. And I was like, no, bro, just wait. He wanted to change his job too. You wait. I was just wait till you're close. 2 days after you're close, bro quits his job. I was like, okay. You know what I'm saying? It is what it is. Now, the 5th mistake and the final one is when people skip the fine print on loans and assistance. It's usually caused by people having a lot of excitement, just people being exhausted, and a lot of times ignorance. Now, buyers take the first loan they're offered, and a lot of times, and don't even look for assistance programs. If rush locked down a house, they can leave thousands of dollars on the table. Give you another example. I've had people come to me because the other agents they're working with or lenders were not helping to get assistance. And then he saw me talk about it and post and stuff about assistance programs and grants and stuff like that. But I didn't know I can get money. I'm like, yeah, you can. You gotta qualify for it though, right? But you can get money. You wouldn't know, they wasted time, effort, and everything, and probably lost on the house they wanted to get just because they didn't know about these programs. So not all mortgages are the same. So you got, conventional loans, which make up, I think, was 70%. Last time I checked, 70% of all loans of home buyers. FHA loans, VA, USDA, and they all have different rules, down payment, fees, and mortgage insurance. By the way, FHA has a little bit higher than conventional. VA, I don't fully remember. I'd have to double check on that. And honestly, taking your first offer It's like, buying the first car you see. You don't really know if you're getting a good price for it without double checking, doing research and getting different points of views. You know what I'm saying? And your interest rate can cost you tens of thousands of dollars over a 30-year period, by the way. So it's important to look into it. Plus, there are tons of first-time home buyer programs out there run by the state and local governments that can help you with down payment and closing costs. But most people don't even know they exist. All you gotta do is ask your agent, hey, is there any assistance? If they don't know, they can't. If you're, if they're your agent, their job is to look into it. Like with my clients, when they ask me for assistance, I look into it if I don't know. That's their job to do it. So how to fix that is become an educated shop. First, get a mortgage quotes from at least, I would say 3 or 4 different lenders. By the way, when you apply for a mortgage application, you have about 30 days to apply really as much as you want. Different ones to see what they all vary, like what they offer and how they vary. And I would say talk to, banks, credit unions, mortgage brokers, compare their loan estimates, line by line, making sure everything's good. Not just the interest rate. A lot of people get caught up in the interest rate. Don't just focus on the interest rate, focus on everything. And second, do some research on first-time homebuyer programs, because that could honestly help you save thousands of dollars and really lower your monthly payments and overall cost of your house. I'll give you another example. I know I keep giving examples because I have a lot of them. Got a client, help him get 40,000. Months later, because of all the assistance he got, he was able to lower the principal and everything. He already paid off 22% of his house, and he's looking to refinance and get another house like FHA and do house hacking and things like that. But if I wouldn't have helped him look into those assistance programs, he wouldn't have gotten 40,000. And his loan payment would still be higher, take longer, and things like that. So it doesn't matter who you work with too, because not all agents are built the same and don't know the same. Hey, I'm obviously I'm uplifting myself, but these are real examples, and you could honestly look me up on Zillow and you can see people talk about it. But really, just to recap, you make sure you understand the true cost of owning a home. Don't fall in love with the first house you see or house you can't afford. Don't ignore your credit and your DTI. Like once you apply, that has to all be situated before. Don't make big money moves before closing or try to sabotage your loan. Failing to shop around for the lower rates and everything and assistance programs is another way how to make yourself not doing a proper, purchase. Buying a home, it's a huge deal if you got a smart plan. So by avoiding these steps and doing the things that are needed so that you can set yourself in the right direction, you're preparing yourself for a better future. Hopefully you can keep growing and get to the point where you want. Thanks for watching. If it was helpful, please subscribe for more videos like this. Be sure to click the notification bell. It should be somewhere. I think I probably wrote it wrong here. Before I forget, how you lower closing costs is just something called seller's concessions. Basically, you get the seller to pay your closing cost. Big part of it. If it's an FHA loan, it can be up to 60%. It's conventional, it's up to 3%. And you can do that, and it can help lower closing costs. And there's other programs and stuff that exist that can do it. So just ask your agent to see if they know. And if they don't know, you're in the state of Michigan, I know how to reach out. Anyways, thank you, appreciate it, and I'll see you in the next one.